Hi, everyone, and welcome to today's webinar, Mortgage Basics, a Newcomer's Guide to Financing a Home in Canada. My name is Riley Cohen. I'm the CEO of CanadaVisa, and I'm very excited to welcome you all here today. We're going to start this webinar with a presentation by our guest from TD Bank. After the presentation, we'll have a question and answer period, giving you the opportunity to interact with our guest. We had many questions submitted prior to the webinar, and we have planned to answer as many of those as possible. However, we encourage you to continue to ask questions in the chat throughout this presentation. Our team of moderators will add them to our question bank, and we'll try to answer as many as we can in the question and answer period at the end of this webinar. I'm happy to introduce our guest speaker today, Darwin Trong. Darwin is a mobile mortgage specialist with TD. He has been with TD for over 10 years, progressing to different retail banking roles in the Toronto area. In his current role, he helps homebuyers with their home financing needs with a specialized focus on new to Canada. In his spare time, Darwin enjoys video games, cooking, learning new skills, and all things tech. Thank you so much for joining us today, Darwin. Again, we're going to have ample time at the end of the webinar for our questions, so we encourage you to ask questions throughout the presentation in the chat below. But please remember the chat is public. Don't share any personal information such as phone number or email in the chat. We're going to remove those messages from chat. Also, one more note, the presentation slides and recording of this webinar will be shared with you in an email afterwards. So if there's a part of this webinar you want to go over again, you'll have a chance to do that after the webinar. I'm going to hand it off now to Darwin to start TD's presentation. So without further ado, here is Darwin.
Perfect. Thank you so much, Riley. Good morning, everyone. Okay, so I do see the slides up. Thank you. And welcome to joining today's TD information session. So my name is Darwin Trong. As Riley had mentioned, I've been a mortgage specialist with TD approaching 10 years now, almost 13 years with the bank. And so just a little bit about myself. Over this time that I've been with the bank, I've gone through quite a learning period as well as a consumer, much like a lot of our viewers will find themselves over the next coming years also. During this period, I found myself I've been fortunate enough to buy a home from a builder. We ended up selling that home. Recently, we found ourselves renting. We've since also purchased and become a landlord for a condo unit. And then I've also purchased a resale assignment property as well. And so, whether it's through work or interaction with clients or even through my own personal dealings, I feel like I'm someone that has been, has seen many, if not all, facets of Canadian real estate, and I'm excited to share some information with a lot of our viewers today. So today's session is all about helping you understand how mortgages work in Canada as a newcomer. And Riley also mentioned throughout the presentation, just for the flow of topics and to keep track with timing, we're going to keep any questions that the audience has until the end. Thanks so much for tuning in. It was really, really cool to see where everybody is from. In my day-to-day, most of the people I deal with are mostly from GTA, some people purchasing, across the country, but it was really cool to see so many people tuning in this early in their morning from all across the world, all across the country. So we thank you for your time and tuning in. So in today's agenda, we're going to be talking about different topics as it relates to home buying. We'll be looking at things that you should consider before purchasing, how to consider and plan for a home buying budget within your month-to-month expenses. What is a mortgage and what are interest rates? Some of the common terminology that surround some of these topics. Understanding down payments, understanding what's a mortgage pre-approval, when you should consider applying for that and what that actually means. Understanding mortgage prepayments and next steps for you as applicants. Right, so this is just just a quick, info slide with my name and my credential within the bank. So I do work directly with clients. If anybody wants to reach out directly for elaboration on any policies, any questions that you might have, you're more than welcome to reach out to me directly as well. And so into our first topic, questions to ask when you're deciding to buy a home, right? So one of the things that I find is that with purchasing a home, that I think is a really important early or first step with the home buying process is really, self-reflecting on not only yourself and how much you can purchase and what you're looking for, because I find a lot, but really prioritizing, I guess, between things that you need and feel as a priority in your feel that would be a priority in your home hunt process, versus things that would be more like a luxury or more of a want in a home. Because I think, without going into too much detail, majority of us are going to want a lot of the same things, right? Like, we're going to want a home in the best neighborhoods with great access to transit, and a great school for our families and kids. We want a big, nice home with nice finishes and so on. Something close to family, with great jobs and so on. But a lot of these things, because so many people want them, they tend to drive up the prices and demand for certain homes. And so as we look at where we want to live, what types of neighborhoods we're looking for, what types of homes we're looking for, you really want to almost set up so I usually tell clients to set up a list of needs and wants, and then also within those lists prioritize, what is your most primary need, what's this, and then what's the second most important, third most important, so that when you speak with a mortgage advisor or play with some mortgage calculators and get an idea of what's your affordability, you can really maximize on what resonates with you as a buyer to tick as many boxes as possible for you, right? So you want to make sure that anything that's really important for you, say that you want to buy a home within a certain school district for your kids, or within a certain vicinity neighborhood of living close to parents or siblings, other family members, or maybe work. These would be things that you would prioritize as a primary need. And then other things, perhaps, access to great restaurants, or types of homes, or it having perhaps a rental component, that kind of thing. If you prioritize those as additional kind of luxuries, you would look for those after satisfying those initial needs within your budget. So owning a home in Canada, as we all know, can be quite expensive, right? And so the expensive isn't just looking at the purchase price itself, but if we look at it from a more in a more detailed perspective, it's expensive in that with home prices being more expensive these days, there are a lot of front-loaded costs, which would be more like your down payment, your closing costs, how much money you need to have set aside and saved up front before you can engage in a purchase. And then there's also the ongoing carrying costs, which would include some of the items on screen here, which would include your mortgage payments, which would be a majority of the the payment that you're paying for perhaps the loan that you would take out to purchase the property. And then there's property taxes, and in some municipalities, school district taxes, condo fees, home and condo insurance, utilities, and emergency and maintenance costs. So rather than just naming these off, I want to kind of just briefly touch on each and kind of explain what each is. So the mortgage payment is the payment that you pay to your lender if you've borrowed a portion of money that was paid to the seller, a portion of the purchase price that was borrowed. So your monthly payment or your periodic payment towards that loan is called your mortgage payment. And within the mortgage payment, there's typically a principal portion of the payment, which is how much you're paying back against the original proceeds of the loan. And then the interest component, which is paid to your lender as a cost of borrowing. For property taxes and school taxes, these will vary within the municipalities that your property is located in. And oftentimes they're priced as a prorated relative amount to the property value. And so an important thing to point out here is that all things being equal, assuming that, if interest rates were not to change and things were to be, stagnant from the time that you purchased until the time that you paid off your home, you'd expect your mortgage payment to be relatively constant throughout the term if rates don't change. But because of inflation over time and price changes, you'd expect the latter items, property taxes, condo fees, insurance, utilities, and perhaps emergency expenses, all of these things will increase over time. So you'll want to plan for that as well within your budgeting, right? So condo fees are not included in all types of properties, but just condo type properties where there is typically property management and amenities, services that are looked after for you with the property. So some examples might include if you purchase a condo apartment in a high-rise building, there may be security or concierge services that they have to collect condo fees to pay. There would be maintenance and management fees collected for maintaining the parking lot or amenities around the building, waste management services, or to maintain generally like sometimes shared facilities, maybe a party room, barbecue patio, pool, gym, things like these. So these would be included in condo fees along with just general repair and other items throughout the building. Home and condo insurance is more for like property damage. Good common examples would be like fire or electrical issues. Some insurances cover different types of water damage. There are like also incidents of theft and burglary, stuff like that for property within the home. You can add this to different types of insurance. So this is another cost to consider. Utilities would just be, of course, like your electrical, heating, gas, water usage, and other utilities you'd have to pay for monthly use and servicing. And then emergency maintenance costs. So this is probably one of the, perhaps when it comes up, can be one of the more expensive costs that not a lot of people budget for in their month to month, because you don't necessarily have to pay the same amount every month. But with maintaining, say, a freehold house, emergency maintenance costs are anything that can kind of come up that you need to pay to repair and replace, that you may want to set aside additional budgeting and savings for when they arise. For example, you may need to redo your driveway, you may need to redo your roof, you may experience problems with your electrical or just wear and tear on the home. So these are things that can add to your expenses as well. And so when we look at all of the mortgage payment and along with all these other types of expenses, typically the monthly house expenditure for renting the same home versus buying today, you'll find that buying is can oftentimes be more expensive for comparison the monthly carrying costs and also the upfront purchasing costs. So here's just a quick budgeting example. If you go into your home buying process and say, I have about $3,500 per month after my typical bills and expenses that I can spend toward housing. So a breakdown might look like something like this, where you would have $2,250 for a mortgage payment. You may have $300 per month going to property taxes, monthly condo fees for $550, insurance for about $100, utilities for about $200, and then setting aside an extra emergency fund for an extra $100 per month would be a pretty good kind of illustrative soft example of approximate proportions and items to consider in a budget. So touching on a budget, other thing I want to mention here is that when you work with a mortgage lender, this is kind of like a default minimum budget of things to consider, right? This doesn't consider individual personal expenses that you have that another household may not. For example, you may subsidize your parents' retirement for say $500 a month, or maybe you send money back home to family living abroad, a couple $100 per month. Maybe you have additional expenses for schooling or daycare, things like that for your kids. I mean, they're not related to housing, but these things do affect your monthly budget, and they will change how much you actually have in order to afford per month. So when you look at affordability, I would encourage people to look at two numbers. I think it's important, one, to ask a lender upfront how much they think you can qualify for for mortgage financing, just to get an idea of how much you could purchase for if you needed to. But then separate from that, be honest and also ask yourself, well, how much can I really comfortably afford per month? And does that align with the mortgage advisor's estimate? Because it'd be unfortunate or tough in some cases to manage if a mortgage rep is advising, you could afford a monthly mortgage payment of $3,000, but because of some of the other unfactored in things, maybe you're closer to $2,500 a month and you should borrow slightly less, for example, right? So overall, this is just to say that budgeting is quite important to consider. And there's a lot of variables that go into it, and everybody's case is going to be a little bit different. But you'd want to kind of take a proactive, organized approach into budgeting as you're planning to purchase. So what is a mortgage? A mortgage is a loan commonly used to finance the purchase of your home, right? So the property is secured for the loan, meaning it's used as collateral, pledged against the loan in case there's default or anything on the property. The lender is able to recoup losses through foreclosure on the loan. So it's a secured form of lending. The definition here says it's commonly used to finance a purchase, but not necessarily always, right? So a mortgage is generally just a loan secured against a property that could be used for financing, but not necessarily a purchase. Sometimes it's going to finance renovations. Other people take out a mortgage to perhaps finance other investments. Could be for a number of things, but it's more or less just a loan against the property. An important thing to discern between is the amortization period and the mortgage term. So very commonly, these terms are mixed up. So the amortization period is the time it would take to pay off the whole mortgage, whereas the mortgage term is the amount of time that your mortgage or loan contract is signed for initially, right? So if we look at the graph on the right here, it shows that with some assumption, assuming rates are the same and assuming that your payments are the same over the course of the mortgage, the main thing here is that the full graph and the full timeline on the graph of 25 years is the amortization period, right? So you're paying off the mortgage at a rate that after 25 years, your whole loan would be paid off, whereas the mortgage term would be the period of time highlighted in green here. So within this example, we're looking at a 5-year mortgage. This would be a 5-year mortgage term where after 5 years, you'd be left with principal corresponding to year 6, and the balance would still be declining. But at that point in time in Canada, you're going to typically renew or refinance the loan as interest rates change, and then continue paying off the outstanding balance from year 6 all the way down to the end of your amortization, right? So one more time, if you had a 25-year amortization mortgage, you have a 5-year mortgage term. After year 5, you would then renew, and you'd have 20 years left on your amortization, and you would renew a new mortgage perhaps for 2-3 years before you renew the mortgage again. So that's the difference between an amortization and a term. So with mortgage interest rates, there's typically, there's several different types of mortgage rates, but the most common ones people speak to are fixed and variable. There's also closed term and open term, I'll touch on briefly too. But fixed rates are mortgage rates where the interest will not change throughout the term of your loan. So for example, if you sign for 3 years, 3 years mortgage rate at 5%, doesn't matter what's going to happen in the market in terms of rates moving up and down, you're fixed in your contract with a set payment of 5% for 3 years before you get to pick and choose and redo a new contract without breaking the existing contract or renewing early. With a variable mortgage, the interest rate can change throughout the term. And so usually, at least with how our variable mortgages work, is you'll have a set payment based on the amortization and the interest rate set at the original signing of your mortgage product. But then over the course of typically 5 years for variable, the prime rate may move up and down with the bank. And so if your payment's the same, but the interest rate is moving up and down, proportionally, you'll find that the amount of interest that you're paying or the amount of principal that you're paying will fluctuate throughout the term of your mortgage. And so if rates change over the course of the mortgage term, you may actually end up being ahead of schedule for your amortization, or in some instances behind schedule for your amortization at time of renewal, right? But with variable, you can kind of chance that, well, people taking variable have the expectation that interest rates will drop throughout the term. And so their aggregate rate over the term will be lower than at the time that they sign. And then I mentioned that there are closed term and open term mortgages. So closed just means that you generally you can only pay the amount of principal and interest set out by your contract, with some allowances for additional prepayment against the loan, but it's not uncapped. So you can't just pay off as much as you want at any point in time. Whereas with an open mortgage, the loan is open, meaning that you can pay off as much as you want, as fast as you want. With that flexibility, oftentimes there is a premium charge for that. And so you'll find most lenders will usually have a higher open rate mortgage than they do for a closed rate mortgage. And closed is by far the most common. So for down payments, a down payment is the amount of the mortgage price of the home that is not being financed and you pay up upon closing, right? So from that definition, if the purchase price is $500,000 and you finance or borrow in a mortgage, say $400,000, the portion that's not financed would be the $100,000 in this case. So you would put $100,000 upfront as down payment, and so the down payment, is the portion of money that you have to put towards the purchase and offer the seller at the time that you close. And for ease, like a lack of a better way to say it, it's the amount that you have to pay. The amount you have to pay upfront right away, or the amount that you need to set aside in savings and account for at the time of purchase closing. Whereas the rest of it, you would finance through a mortgage and borrow and manage to pay that off over time, over a series of mortgages and refinances. Right? So some lenders have mortgage solutions tailored to newcomers, and they may have specific down payment requirements. So two common thresholds in Canada for down payment are mortgages that have 20% down payment and mortgages that have less than 20% down payment. So a 20% down payment, why this is a key threshold, is because lenders can lend only up to 80% through what's called conventional lending without going through a default insurer, right? So any lender can offer up to 80% without requiring you to purchase default insurance from Crown Corporation, Sagin, CMHC, Canada Guarantee. But if you have less than 20% down payment, then you need to purchase and qualify through these Crown Corporations on top of qualifying through the lender's policies, and through that way you're able to purchase for with having a lower down payment in hand, following certain criteria, right? And so I know there's probably going to be some questions. Things aren't fully finalized or formalized on our side, but there's some changes around the max borrow limits, purchase limits, and amortizations around this program that will officially launch later in this year, coming December. And then so with down payment thresholds, another common threshold you'll find with lenders is that with 35% down, typically, or sometimes more, sometimes less, 25%, but just as an example, with higher down payment thresholds, some banks have different lending policies, where if you don't qualify under traditional lending policy, but you have a stronger down payment, so your deal is a little bit risk friendlier for the bank, we may have some different policies to qualify you and be able to still offer a mortgage in some different circumstances and situations. Right. So a pre-approval is when a potential mortgage lender looks at your finances and decides how much they might lend you and at what interest rate they may charge, subject to certain conditions. You might end up being pre-approved for an amount greater than what you want to borrow or less. And this doesn't mean that you need to borrow all of it. But as we mentioned before with budgeting, a mortgage pre-approval is going to give you a gauge of approximately how much you can expect to pay per month. So you can kind of factor this payment in with some of your budgeting plans and decide if this kind of aligns with your purchasing plans and what types of properties you're going to look at. Why get pre-approved? So a pre-approval helps you understand the amount that you're able to borrow and also locks in an interest rate for you. Note, getting pre-approved is not a promise that you'll get approved for a mortgage. Make sure you understand all the conditions of the mortgage pre-approval. So a key thing I want to point out here is that a pre-approval is really just a good educated guess for you that when you go to purchase, this is roughly how much you'll be able to purchase for. There is a common misconception that, if you're pre-approved for example, 500,000 mortgage, you can go out there and purchase any property and expect with guarantee you're able to borrow 500,000, which is not always the case. And that's why it's an educated guess. Some examples where this may not qualify would be if you were to purchase and need to borrow 500,000, but you might be purchasing a home that has $1,000 per month condo fees versus another home that has no condo fees. You might imagine the one with $1,000 condo fees will affect your monthly finances and ability to budget for that differently. And so lenders will assess that differently as well. And so commonly, if the housing and carrying cost is more expensive for the same size loan, you might find you may qualify for a little bit less. Another good example of this is that let's say that you purchase and you're pre-approved for 500,000, but then when you go to get your property appraised and you've purchased, maybe the appraisal comes back lower than you expect, and the bank can only lend you again up to 80% of the property value. If the appraisal comes back short, and even though you're pre-approved for 500,000, we may not be able to lend you enough on that property, and then you've committed to purchasing. Right. So a pre-approval is really just a good gauge for you to kind of get in the market and start looking at homes. But that doesn't necessarily void the need for a financing clause with your offer. And the other thing here I want to mention is that we mentioned here that a pre-approval helps lock in an interest rate for you. I do want to stress something I tell all my buyers and clients is that think of interest rates as a rate ceiling. Right. So when you get a pre-approval, it doesn't mean that you're committed to the lender you're pre-approved with. You don't have to get a mortgage with that bank. You don't have to, accept the terms and conditions of the original pre-approval only. Throughout the whole purchasing process up until your closing day, if interest rates change and they decrease in favor for you, or you want to change maybe from a 2-year fixed to a 5-year fixed mortgage, for example, you can change that at any point in time. So it's not a commitment on your side. Really, it's just a good snapshot of your current situation and gives you the security of a rate ceiling in that if rates increase, we will honor it. And it gives you a good confident estimate of how much you can be looking at in the marketplace with your agent. So mortgage prepayments. You can make additional payments to pay off your mortgage sooner. These are called prepayments. So payments above and beyond your standard, your regular scheduled payments. So if you have monthly scheduled payments and you're making additional payments on top, these would be a prepayment. And prepayments could be in the form of a lump sum or increasing your regular payment. Prepayment privilege is the maximum prepayment you can pay without incurring a penalty and will vary by mortgage lender and mortgage type. So just a quick kind of cool FYI in our current snapshot of the existing market, and things will change as rates change and the amount you borrow changes and the amount of the term of your amortization. But on average, I would say a good number of borrowers today at current interest rates or more recently when I've looked at it, people can find that over the course of their first mortgage term, when you look at all of the interest you've paid and all of the principal you've paid over the first mortgage term, because the loan size is biggest upfront, and with each subsequent payment on your mortgage, you're typically paying a bit more principal and a bit less interest. In that first term, you may pay, I've seen, contracts where clients are paying upwards of 50, 60% of all the payments are going towards interest and not principal. So with prepayments, anything you pay above and beyond that goes directly against the principal, right? So in an example where in the initial term, you're paying 50% towards principal, 50% towards interest, any prepayment you make is, it's counting almost 2 to 1, or it's twice as efficient as your regular payments to pay, because it's paying 100% of the principal, not 50%, right? So prepayment privilege is something that we as a bank are very, very flexible on. There's a lot of flexibility for increasing your payments, making lump sum payments at different intervals, and this can really add up and save you a lot of interest over the course of paying off your mortgage. And so as next steps, TD can help you finance your first home in Canada with specially designed mortgage solutions for newcomers. You may be eligible for a TD mortgage even if you have no Canadian credit history, provided you meet eligibility and credit criteria at TD. Here, there's a website that you can visit with some additional information as well. You can request a call from a TD mortgage specialist to learn more about mortgage options after you have arrived in Canada. And with that, I will turn it back to Riley and team for questions.
Great. I guess first off, thank you so much, Darwin. Very insightful presentation. I appreciated it, and I know that the audience did as well. So first things first is thank you. Moving on to the question and answer period for the remaining time of this webinar. Once again, I want to remind you not to post any personal information in the chat because the chat is public. We have received a lot of questions prior to this webinar. We're going to try to get to as many as possible. And we know that some of you have posted questions in the chat throughout the presentation. We will get to as many of those as possible as well. And also I want to encourage you to continue to ask questions during the question and answer period. If you have any follow-ups, and we'll try to include those as well. There's a couple questions here that maybe I'll address first, which is, I think David just asked it in chat about the presentation links, and Mahmoud asked it as well. Are you going to share the slides with us? As a reminder, the slides and this webinar recording will be shared with you tomorrow. So please take a look in your email tomorrow for recording of this webinar. All right, let's start with the questions and answers we've received. There's a lot of questions here, Darwin, about who is eligible to buy a house in Canada and under what status. So Cindy asks, when are foreigners eligible to buy a house using a mortgage?
Sure, yeah. This is a very common question today, specifically since I think it was January of 23. The government had put out an act called the Prohibition on Purchase of Residential Property by Non-Canadians Act. And so this is essentially what people call more simply the quote-unquote foreign buyer ban. Right. And so with that policy, originally it came out in January of 2023, expected to, I guess the policy was going to end at end of this year, 2024, going into 2025. I believe it was recently extended into January 2027, though. Right. And so while there is a foreign buyer ban, it doesn't mean that everybody that's not a Canadian born citizen can't purchase property. There is a lot of fine print and a lot of circumstances where different demographics of people can qualify. Just touching on a couple without going into detail. So this would be if you are, of course, a Canadian citizen, you've been granted permanent residency, you're registered under the Indians Act, if you're a refugee, if you're on a work permit, if you're on a study permit. It's not only that you meet these criteria, but within those, there's certain sub-criteria. Like, for example, a work permit may require a certain amount of tenure with a full-time Canadian employer for a certain amount of time. So there's fine print within each program. And so for something like this, I think it's a common question, but I think it's best to reach out on an individual basis, whether it's to someone like myself or a preferred lender that you already know and work with to clarify eligibility. And a lawyer would be a good point of contact for that too, a residential real estate lawyer.
Great. Thanks, Darwin. A couple questions here about choosing the right mortgage/advisor. Aditya asks, how do I choose the right mortgage advisor? And I think Kyron in chat just asked, should you shop around and talk to different banks when it comes to getting a mortgage?
Yep. So I mean, my question hopefully doesn't come up with any bias because I'm a mortgage advisor as well. But I think with choosing a mortgage advisor, just the same as you choose any professional, you want to pick someone that resonates with you, puts in time and really works with you, caters a solution for you, and someone that you can trust. Of course, in the current marketplace, product policy, offerings, promotions, all that stuff is important to consider as well. But ultimately, I would actually discourage from only working with one person, and perhaps encourage you to do your due diligence and reach out to multiple people to get a pre-approval with one or a couple lenders, and kind of see who can offer you the best advice, who you're most comfortable working with, and who can give you the best best approval, product offering, and kind of work from there. And a lot of time, like your realtor, as you're looking at places, will have connections and contacts as well. But personally, that's how I would go about it.
Awesome. Thanks. A couple questions here about a variable versus, I guess, static mortgage rates. Yep. Tracy just asked, for the variable mortgage, what is the difference between a fluctuating versus a static mortgage payments?
Yes. So, great question. Because there's a lot of headlines of people impacted by the differences here. So with a variable mortgage, we mentioned that variable mortgage is the portion of interest will fluctuate as the Bank of Canada, and then indirectly all of the Canadian regulated banks or most lenders, prime rate will change when the Bank of Canada central bank lending rate changes. And as prime rate changes, variable rates change. And as variable rates change, the portion of interest you pay and relatively the portion of principal you pay changes. Now, with the variable payment scenario, when interest changes and the variable payment mortgage is designed that you maintain your amortization that you set up when you originally set up your mortgage. So if interest rates increase during this time, then being that the portion of interest paid has increased, your monthly payment will proportionally increase so that you're still on track with your amortization. Right, so the variable the payment's going to move up and down based on the amount, your monthly payment or your scheduled payment throughout the term. Doesn't matter what your original contract payment was, it's going to change with the interest portion payment of your mortgage. Whereas with the static payment, you pay the same amount for every scheduled payment, but within that scheduled payment, your portion of interest and principal fluctuate. So with us as a lender, ours is the static type payment mortgage for variable, whereas other lenders have the variable payment option. I mean, this is a bit debatable and some opinion here, but my perhaps biased opinion, I personally prefer the static payment option because it was a case, unfortunately, with unprecedented interest rates increasing as much as they did. The variable payment option for a lot of people was forcing people to increase payments at, for some households, unfortunately, almost unsustainable payment increases. Whereas with the static payment option, households were able to increase the payments as much as they could sustain. Of course, if they weren't increasing enough to maintain their amortization at renewal may be longer, but it was the more budget friendly out of the two, because you had the option to increase to maintain your amortization, or you had the option to increase and just cover interest and as much principal as you can for the term until you have to refinance or restructure or otherwise.
Right. Great. Thank you. Paula asked by email, Can someone over 55 qualify for a mortgage amortization period of 30 years?
Yeah, absolutely. Absolutely. You definitely can. So there's no, yeah, we don't discern. There's no like cutoff or anything, or there's no like max age of lending. So for example, like I guess from the nature of that question, we don't have a scenario where, for example, we say, the mortgage has to be amortized to a max, 80 years age or something like that. So we wouldn't subtract like age minus that cap year and only offer that amortization. There's no restriction there.
Great, thanks. Judith asked, do you need to be employed to buy a house, or can you buy a house with personal business income?
No, so for personal business income, we would say is still employed. You're self-employed and not working for a company, and you can certainly qualify for financing. Absolutely.
Great, thanks. Um, Mariana asks, if I take on a 30-year mortgage, am I able to pay it back in 10 years if I want?
Yes, so definitely you can as well. So kind of just additional info here. When I said that, TD's prepayment options are very flexible, we allow for 15% of original borrow amount to be paid on top of your regular mortgage payments per calendar year. It doesn't have to be 15% and doesn't have to be in one go. It can be several lump sum payments throughout the course of the year. And on top of that, you can increase your scheduled payments up to 100% of the original amount. If you were to take advantage of all of these prepayment privileges, even if you started on a 30-year max amortization, you'd find you'd pay off your mortgage theoretically well ahead of 10 years. So there's a lot of flexibility there.
Awesome. John asked, what credit score do I need to qualify for a mortgage?
So this is more of a nuanced type exception question, because there's always circumstances where people may not meet the ideal criteria, but their exception garners their scenario garners an exception that can still grant approval. I would just say that in general, for most lending policies, at least with A lenders, the ideal credit score is like 680 and higher. But there's certainly instances where we can offer lending for lower scores with explanation of what happened with the score. Example would be maybe layoff or medical emergency, things like this. Well, there is compassion and consideration for these things, right? And but in instances where you have a lower score, as you might expect, you'd find the qualifying criteria or the amount offered for lending might be a little bit more stringent than someone with stronger credit score. But there's no kind of hard minimum. It's on a case-by-case basis for lower scores.
Great, thanks. Randy asks, what is the smallest down payment I can make?
Yeah, so smallest down payment you can make in Canada for purchase is through our default insured lending programs. And so with that, it's 5% of the of up to for 500,000 for the first, 5% down payment for the first 500,000 of purchase price, and then 10% for anything additional, right? And so up until recent changes, not formally fully implemented yet, but the current policy is you can purchase under this program up to $1 million, and up to $1 million. So for example, if you purchase for, we'll say 800,000. The first 500,000, you'd need 5% down payment, 5% of 500 being 25,000, and then for the price portion between 500 to 800,000 being 300,000 of purchase price, you need 10% of that portion, right? So 10% of that being 30,000 plus the 25,000 from the first 5% of the first 500, that would be in this example 55,000 down payment, right? So.
Yeah, thanks. A few questions here about, and I just want to get to these because a lot of people are asking about previous employment or income or maybe assets abroad. Does that help with my mortgage?
It does definitely. Yeah. So I mean, there are instances where, if your income is abroad, you've moved to Canada as a newcomer, for example. Of course, in some instances, that income is not going to translate to here because you're reestablishing a new life here, a new income here. but it is going to help for reasonability consideration of what type of professional you are back home, what type of business are you planning to set up here, and so it kind of paints your picture as an applicant. And so generally, all lenders are going to want to know that history of what type of education you did, what type of work you previously did, what type of earnings you typically earned in the past, where your savings are from, and all of that stuff comes into play for sure.
Great, thanks. Jennifer just asked, sort of, I guess, as a follow-up to this, can my family abroad or inside Canada help with securing a mortgage?
Yep. So there's two ways to kind of interpret that question. Family abroad, if they don't fall under the prohibition, on the purchase of residential property by non-Canadians Act, if they don't qualify to purchase in Canada as a buyer, then they wouldn't be able to help you as a guarantor or co-owner on title. But they may help you indirectly through gifting you funds for your down payment. And so I guess to look at all options, whether they're able to help with the mortgage financing affordability or simply just indirectly by gift, would be a good question for a mortgage specialist to look at.
Great, thanks. Shashank asked, does a better credit score help with lower interest rates?
No, this is actually a great question. I would say, I don't know if it's the case with all lenders, but at least with us, I would say that is a myth. What I would say, because the takeaway is what does affect rates. Generally, things that affect rates are going to be, your relationship with the bank, your total, volume of business that you do with the bank, the size of your mortgage loan, current market conditions, Canadian bond yields for fixed rates and how they're doing. And then negotiation, sometimes complexity of your deal, and there's other factors, but I would say those being majority of it.
Great, thanks. Aditya asks, can we fix the interest for the entire amortization period, for example, 25 years?
No. So the longest term mortgage, at least we offer, is 10 years. Granted, though, after 5 years, it seems to scale up pretty quickly. You'll find that the 6, 7, 10-year mortgages rates are they jump higher than, say, the difference between a 3 to 4 year, 4 to 5 year. When you jump from 5 to 6, 6 to 7, or 7 to 10, the rate is proportionally a bigger jump than some of the more common terms. But we don't offer a mortgage term for the full amortization.
Great, thanks. Mahitha just asked, do I need to be pre-approved or pre-qualified for a mortgage before I look at homes?
You do not need to be, no. So, generally, though, when you do go to look, if you haven't purchased before and you haven't worked with your agent before, there are a lot of agents that will tell you they may not want to take you to look at homes before you get pre-approved. And also, when you go into looking at homes, again, I would encourage, there's really no downside of you being pre-approved. It just gives you more confidence as a buyer going into the market, because you might find a home that you think is within your budget, but with the way bidding and stuff is structured here, you might need to add an extra 30,000, 40, 50,000 more than what you expect. And so you'd want to have a lender that you can quickly reach out to. And it's good, probably one of the best value adds of having a pre-approval is you have a dedicated professional to answer those questions on the fly during your listing. So a lot of times, clients reach out to me 10, 11 o'clock at night on weekends. They'll say, hey, there were the sellers accepting offers today. This is the listing. Do you think we can get this much mortgage, right? And if you don't have someone you're already working with, then it's going to be harder to kind of make that contact at that point in time when it's pivotal for you to make that decision. But the short answer is no, you don't have to have a pre-approval, but a lot of agents will want you to have that in hand, and I think it definitely helps you.
Right. And Mel just asked if we're going to be sending out a copy of the recorded webinar. We will be. So stick around for the end, and we'll send you tomorrow a recording of the webinar with the slides. Great. Bishnu asked, and this might be a short one, what is the meaning of condo fees? What are those?
Yep. So condo fees, it just covers different types of management expenses for your condo, which is a very broad explanation, but it can cover things like fees for amenities, fees for security, fees for repairs within your building, fees for any other kind of miscellaneous costs that the condo corporation may incur. And so they collect condo fees from all of the unit owners, typically based on the relative square footage of their unit. And then that's what the condo fees go towards paying, is all of those things and others.
Great, thanks. Aditya asks, in case I lose income or something else happens to me, is there a way to protect my home?
For loss of income, sorry?
Yeah.
There are. So there's different types of insurances that the clients can take. So it's a great question. At TD, we offer insurance for life insurance. On mortgages, we offer terminal illness coverage. So if you're diagnosed with a terminal illness, we offer major accident coverage. So if you get in an accident and you suffer from an injury resulting in loss of vision or loss of 2 limbs, then the life insurance policy will step in and pay off a portion or all of the mortgage if you have that coverage in place. We also offer stroke, heart attack, and cancer coverage called critical illness insurance, which you can get that will also mitigate or pay off a portion or all of your mortgage with that insurance in place. There are, I believe, with other lenders, we used to offer it as well. There's insurance that kicks in during like job loss for a couple of years. Again, we no longer offer that, but if you're laid off for long term, then that type of insurance, at least as we used to offer it, would cover typically it wouldn't pay out the mortgage, but it would make the periodic payments for you for a certain amount of time. If you qualified for that type of coverage. But generally, the answer to this question is insurance, and you'll want to look for the type and premium that kind of suits your budget for what you're looking for.
Great, thanks. Paula just asked, how can you reach out to Darwin?
So the easiest way to reach me would be, just if you just look up my name, you can reach out by email. Reaching out by email would probably be easiest, but generally, from there, very accessible by phone, email, or otherwise.
Great, thanks. Kwabena asked, what mortgage options are available for newcomers to Canada?
Yep. So for newcomers, we do have a new revamped program. Again, there's a lot of technical variance within the policy for different people. Like it's there's different underwriting criteria if people are self-employed versus if they're newly employed. It might fall under our temporary resident policy and stuff like that. I would say that we do have policies in place that go above and beyond the conventional lending policy, but that's a good individual question to reach out and see your how policy meets your personal circumstance and criteria.
Great, thanks. Jennifer asks, is it possible to have 2 mortgages?
Yeah, definitely. People have, just like within our bank, our policy allows people to have up to currently 9 rental properties, with 5 of them being financed by TD on top of your primary home. Other lenders will have, variations of similar policies, but you can definitely have, a number of mortgages for sure.
Great, thanks. Petronella just asked if there's a program specifically for healthcare workers.
There is. So we have a program specifically, not for all healthcare workers, but we have one specifically for dentists and doctors.
Okay, great, thanks. And I'll take one more question here. I think it was from Tracy, where earlier you talked about reaching out to a residential real estate lawyer about the eligibility criteria. Is that something that a mortgage advisor can sort of help you find?
Yeah, definitely. A lot of the time, policies we can't recommend only to like one lawyer, but typically we'll have a number of contacts you can reach out to whoever you're most comfortable with. At the same time, too, reaching out to your lender internally, we have resources as well, where we can kind of look at what's mandated by the government for criteria, and also what works within our policies, because it could be a pretty straightforward, easy scenario where we know we can work with that one, right? So, yeah.
Well, thanks so much, Darwin. Really appreciate your time here today. I know that the chat was super engaged. I was really impressed with everyone's questions. And I know that there's more coming in, but unfortunately we can't get to everyone's questions. But I want to thank the chat as well for being really engaged with this topic. A couple of housekeeping notes. We're going to be sending out the recorded webinar and the slides in PDF format to everybody tomorrow. So if you want to go over a portion of the webinar that you wanted to get into more detail on, you'll have the opportunity to do that tomorrow. Darwin, I'm going to hand it off to you just quickly in terms of next steps for the audience, how they can reach out to you, how can they learn more about mortgages and TD.
Yep. So yeah, with that, I kind of want to mirror your sentiment a bit as well. Great to see so much engagement again from people all across the country, all across the globe, and lots of Ontario people as well, local to me. So for reaching out to me, easiest would probably be by email. So I'm at darwin.truong@td.com. And then for next steps, I think that's obviously going to vary for a lot of people. I think the first step, typically, at least what I like to do with clients, is to just go through verbal, what their situation is, what their story is, what they're looking to do. And even without a credit check, without any formal commitment or sometimes paperwork, we can quickly come up with a more educated guess of how much they can afford today, what things they can consider doing, or perhaps adding co-borrowers, or how they can kind of structure around what it is they're looking to do, so they can kind of plan the next steps into moving towards their purchase.
Great. Darwin, thank you so much. Really appreciate your time today. And we look forward to doing more of these in the future.
Absolutely. Thanks. No problem. Thank you, Riley. Thanks to everyone.
Bye.
Bye.